Yo guys, welcome to the new video. In this video I talk about the money transfers in the marketplace, where the money get transferred and how the move will happen. These are the examples of some of the money transfers after the liquidity being taken out and mitigating the point of interest. This is the basic view of the money transfer. So let's look the deep dive into the money transfer concept. So basically the market moves like this. It will leave the liquidity for the future. This is how the market moves, right? From the liquidity point to the liquidity point. This is the inducement. This is the money transfer. Again, this is the inducement, and mitigation is the money transfer. If there is a point of interest without the inducement, it is the fake order block. If there is a point of interest without the mitigation, it is the fake order block. Why this is the fake order block? Because there is no liquidity grab or money transfer here. There is no liquidity grab here in order to take a buy. But here the liquidity got taken out and the money got collected and also mitigated the point of interest so that we can buy the market. Again here in this case, the market, you should understand the market oscillations. The market did this retailer's pattern. So here it has lot of liquidity in the downside, right? Lot of liquidity in the downside. On the upside, so the liquidity, I mean money, is collected and mitigated here, so we bought the market. Simple pattern it is. This is how the retailers got trapped, the smart money people got trapped, money got collected, and the move will happen. So everybody will think the market maker will hunt their stop loss or nothing. They don't do it intentionally, but it is the part of the process to fulfill the orders. Because let's say if the market is moving like this, the broker needs lot of sell orders, because if lot of people are buying the market here, the broker should provide the opposite type of orders, means the sell orders, right? So here the market maker should provide the sell orders, and again here also the market maker should provide the sell orders. But if the market maker ran out of the liquidity, the market maker needs money to fulfill the orders. Just to fulfill the orders, in order to fulfill the orders, the market will approach this level, because here stop losses will be there, right? The stop loss will be here. So the money got collected, and it will deliver the price. This is the main reason of the liquidity graphs, because if the market maker ran out of the liquidity, they induce the people and then it will move in the real direction. This is how the money transfer happened, because let's say if everybody knows the strategy, they will buy here, buy here, buy here. So in order to buy, the broker should sell, right? One person buy, another person sells. So if the broker has zero liquidity to sell the market here for the buyers to facilitate the orders, they need some money, right? So their money is from here. The broker gets money from the stop losses. So if money get taken, so now the buyers will enter again, buys, so that the market can facilitate the buy orders again. Buy, buy, buy. This is how the market moves. This is the oscillation of the marketplace. So now we deep dive into this concept in the real charts. Okay, if you see here, if there is a liquidity gap and the point of interest above it, it's a 99% probability that it will hold the move, because it's a money transfer. See this liquidity. These vertical lines are the session breaks, because I use it to mark the session high, session low, and the days high and days low. Every money transfer undergoes the liquidity graph of, I mark the horizontal lines, right? These are the liquidities. Liquidity, point of interest, mitigation. Same thing. Liquidity. This is the clean POI. If you see the clean point of interest, liquidity, point of interest, mitigation. Here also the move I took here, liquidity, point of interest, mitigation. Same thing, it will happen over and over and over and again in the marketplace. So let's example. First thing you should identify is the liquidity. You should zoom out of the charts and identify the liquidity in the marketplace. Where are the liquidities? You should identify it. This is one liquidity. That's why this buy move is happening, because the money got collected here. Lot of money is there, because lot of people will looking for the buy the market here. So money got collected and the market maker will move the price out until this resting liquidity waiting to be taken out, right? So this is how the market moves from one liquidity point to the another liquidity point, because it's just for the money. Liquidity is just money. Liquidity is a fuel for the price. If you see here, if you see in the price action happened here, the market did this, did this, did this, did this. So what happened is the market maker ran out of liquidity, because every smart money people will sell here, will sell from this order blocks. So the market maker needs buy orders in order to fulfill the sell orders. There will be ton of people here selling the market. The market maker now have zero liquidity. In order to gain the efficiency of the price action and fulfill the order, it will intentionally take this stop losses. Now it got lot of liquidity and buy orders. Now it will move the price. This is how the cycle works. This is the intention of the market makers to take the liquidity and move in the real direction. So this is what the money transfer is. The first thing is we should always wait for the liquidity graph. This is the clean liquidity and this is the clean breaker block. Market tapped into the efficiency money transfer. Again here, the market maker grabbed liquidity, move. Again, the market maker, if you see small details, you should pay attention to the small details. If you go into the low time frame, this is the liquidity graph. And also these liquidity graphs happens at the specific timings like magic minute timings and etc. Lot of concepts are there to explain, but I will explain very slow so that you can understand without confusion. Same thing, same cycle, mitigation, liquidity graph, move. Easy concept if you grasp. Here what happened in the low time frame is the market is moving like this, liquidity grab happened, mitigation happened, so the move happened. That's it, simple. And by the way guys, I am offering a huge discount to my one-on mentorship. Currently I am just doing it for $250. It's like the offer will be there for around a week. If you want to join, utilize this. This is a golden opportunity to change your trading career entirely. See, same thing. You will be amazed. I am showing you tip of the iceberg. I am just showing you the top 5% of my stuff. There are a lot of to this. There will be specific magic minute timings, where to enter, which, for example, if I just explain you like this is the liquidity graph and everything. But sometimes not every liquidity graph works. For example, let's see, this is also liquidity. Why this didn't work? Because there's some mistake in the timings and everything. We should check the timings where the liquidity graph happened, and I will also check my indicator with the TDI whether the liquidity sweep is there. If you see from this high to this high, there is break in the TDI also. So that's why this is the break of the structure. This is not the liquidity graph. There are many confluences are there which I teach to the mentorship people. So if you want to join, utilize this offer. So if you see here, the price has mitigated this breaker block without taking the liquidity. So in the future, it will use it as the liquidity. This is the resting liquidity waiting to be taken out. So that's why market. So after this liquidity got taken out, I will sell the market. Same cycle you should wait for. You should always wait for the liquidity to be taken out. For example, if you are in the selling trend, you should mark the highs and lows as the liquidity. Wait for the liquidity graph and wait for the mitigation. Then enter. Limit order here. Enter. Target this liquidity. Again, if there is an order block in the past, you buy the market. Target this. This is how the markets oscillations work. Not like clean structure like this. This is bullshit knowledge. No market works like this. Every market works under the liquidity. In Forex, the manipulation is more because many people will trade, right? So the aim of the liquidity is very high. Liquidity needs, the broker needs lot of liquidity in order to provide the liquidity to the members. So that's why these type of manipulation move happen. But see here, lot of easy concept this is. The money got transferred from here, the money is here. Now this is inducing the order block. This is also a money transfer. Let me note it down for you. This is how you should structure your money transfer. In every time frame, the money transfers will be different. The concept of money transfers will be different. You should always trust the higher time frame. For example, if you see this chart, if you see the chart here, this is the higher time frame liquidity that got taken out and mitigated this point of interest. According to the lower time frame entries, if you are scalping the market, this sell is very high probable. My students, some of them, my students are scalpers and they trade like this. Same cycle, liquidity got taken out, point of interest. But I am swing trader. I don't take these moves. I take very high quality trades, only high quality trades. You can sell here and you can buy here. You can literally pick pong the price if you want. There are lot of ways to trade the market like this. This is very easy style of trading. If you understand the real concept of the liquidity and broker, how the liquidity is provided to the brokers and everything, you should know this stuff in order to be profitable in the marketplace. If you don't understand the liquidity, you will become the liquidity for true. Same thing happens over and over and again, guys. Same thing happens over and over and again. Liquidity got taken out at the tip. If you see, small sweep, enter the buy. These type of clean moves, I will enter. I will only enter with the clean higher time frame liquidity. If you see, this is the daily liquidity. So that's why I entered the market and targeted the inefficiency 17 hour trade. You should have patience in the market. My edge occurs over 2 to 3 times a week and I will at least target 15 hour. You can do a math. Same thing. This is how the market moves on the liquidity. These are the money transfer. Money will transfer. If you see, after the liquidity is taken, the new order flow establishes. See, order flow. So this is the order flow that was not mitigated. So in the future, it may give that some reaction. It may give some good reaction. In the future, this zone may give some good reaction because the money is still there. The money is still here. Again, see, you can ask why this sell happened without mitigating this. Again, same thing. This liquidity got taken out, right? This is the liquidity, and this is the always the money don't flow, don't mitigate the tip of the point of interest. It can mitigate the trend because as the money is came, the mitigation is not necessary. Just the liquidity grab is necessary. Mitigation is the second thing we look at. The mitigation is the first thing. So, in order to remember what I teach you in this video, first thing you should look at the trend where the market is going, whether it is going in the downtrend or the uptrend, and you should mark the liquidity levels like this, green and red, and you should mark the point of interest. It is the very high probable, very high probable setups. If you see here in the lower time frame, in the 1 minute, if you go to the 1 minute, how it will be is after the mitigating of the order block, it is like this. Let me go to the 1 minute and show you how this stuff works. 1 second. Yeah. If you see here, this is the break of the structure. So the now trend is bearish. So we should understand where the liquidity is. Where the liquidity? The liquidity is here. The liquidity is here. And the mitigation, where's the mitigation? And the mitigation is here. If you see here, this order block is mitigated, but this order block is not mitigated, and these are inducing liquidity grab. Same cycle over and over and again. We'll sell the market. My students will sell. Yeah. For my one-on-one students, I explain this entire strategy in 1 month with specific order blocks, timings, divergence, how to use divergence correctly, and everything. Again, where's the liquidity? Where's the liquidity, guys? The liquidity is here. If you follow the oscillation of the price, how it's moving, this is the movement. So you should understand the liquidity. This is where the liquidity is, and where's the mitigation. The mitigation is here, because just follow the money. Mitigated. This is not mitigated. Just sell the price, but if this is midnight, we ignore. But you can take if you trade this time. Simple trading, simple trading. Again, if you follow the money, if you follow the oscillation of the price, break up the structure, So you should, in order to be profitable in the market, you should understand the liquidity, right? So just understand the liquidity and mark the liquidity. This is the liquidity. And if you go to the at least 1 hour time frame, this will be your order block. So I wait for the opposite candle to be closed. So 3 pip stop loss makes sense in this scenario. And you should target the next liquidity. Where is the next higher time frame liquidity? This liquidity. I will be in this trade for sure, because everything is clean, right? So this is the complete explanation of the money transfers. First you should identify the liquidity, point of interest, mitigation, etc. So currently offer is going on. If you want to join the one-on-one mentorship, just go to the comment section. I dropped my WhatsApp number. You can join through that by texting me. Peace, guys.